Welcome back. You're still with us on Markets Today. Well, the 371-page economic survey was tabled in Parliament today. The survey highlighted that India had moved on from its encounter with the pandemic and projected a real GDP growth of around 7% this fiscal. It also forecasted a 6.5% real GDP forecast and 11% nominal GDP growth in FY24. Well, Lata joins us with two big takeaways on growth as well as the fiscal deficit. Lata.
Well, the economic survey clearly is forecasting a higher GDP than what the CNBC-TV18 poll was saying for FY24. The survey forecast 6.5%, whereas our survey had only got 6%. Now, what is the survey's argument? The chief economic advisor argues that corporates now are in much better health, balance sheets because leverage is low. Banks are in much better shape, GNPA is lower, and their capital adequacy is almost 16%, very high. Now, these have been the situation for the last 2 or 3 years, but because of the pandemic, the flow of reforms, GST, bankruptcy code, other ease of doing business measures, PLI, these couldn't flow through because of the pandemic. But now that the pandemic is behind us, and if anything, global inflation this year will be lower than last year, logistical constraints will be lower than last year, the stage is set for credit offtake, capex cycle to pick up, and therefore he's betting on a higher GDP. He says all this will easily produce 6%, plus India's investment in public digital infrastructure, like, UPI, ONDC, direct benefit transfer, the JAM Trinity. All this will now flow through easily because the one-off hurdles are over. Hence, the bet on 6.5%. In fact, in the medium term, from 2023 to 2030, he's betting that India's potential growth will be 7 to 8%. The other takeaway for me is on the fisc. The survey argues very strongly in Chapter 3 that the fisc has improved in many ways. The first point he makes is GST, and you just look at the table. He points out that if you take the taxes which are in the GST, sales tax, etc., in the FY13 to FY17 period, those taxes grew by a CAGR annual rate of 11.53%, whereas GDP grew by 11.54%. That is, for a one unit rise in GDP, taxes grew by less than 1. But in the period post-GST, from FY19 to FY22, GST has been growing by 10.9% annually, although nominal GDP grew by only 9.6, which means for 1 unit of GDP growth, you are getting 1.1% growth in GST. He is proving that tax buoyancy has improved. And then he goes on to prove that even direct tax collections have been much better in the recent period, April to November data that we have. Taxes have grown by, direct taxes have grown by 15.5%. In the pre-COVID period, they were growing annually by 13.9%. He's also going on to say that, capex growth, in the capex expenditure in the budget in FY23 was 2.9% of GDP. In previous years, 2009 to 2020, capex growth was only 1.7%. So in various ways, extra budgetary expenditure, debt, used to be very high 3 years ago. Now that has been reduced to 0. So the point is, in transparency, in tax buoyancy, everywhere the fisc has improved. And he goes on to say that the best way to encourage growth is to bring down the fiscal deficit so that the cost of capital for everyone falls. So that gives me a hint that the fiscal deficit is probably going to be lower when the budget is presented.
Okay, all right, Lata. Thanks a lot for that. Well, moving on to the fourth headline today then. Anticipation of further Fed rate hikes and a strengthening USD put some pressure on commodity prices. Manisha Gupta joins us to run us through a wrap of all the action in the energy and the metal space. Manisha?
Well, even as we are posting a firm first month of 2023 for most of these commodities, but we have seen prices come off the highs today. Whether it is copper and aluminum, which were trading at a 7-month highs, have come off. So is the case with the precious metal prices also, where gold and silver prices have declined, and crude oil prices have also fallen by 3% on a week-on-week basis. This is because of the strength in US dollar, which is trading at about 102. The markets are now looking at the US Fed meeting, the first for 2023, with an expectation that we are looking at 25 25 basis point of a rate hike, which will bring us to a range of around 4.5 to 4.75% of a range. But the U.S. Fed is just one of the central banks meeting in this week. You also have the European Central Bank, Bank of England monetary meetings this week, where the expectation is that you could be looking at 0.5% of a rate hike there as well. And it doesn't end there as well. You have the OPEC and allies meeting also happening on 1st of Feb, which is tomorrow. And then on Friday, you have the U.S. non-farm payroll data as well. So there is just way too much to keep reacting to. And ahead of all of these big meetings, there is some profit taking and some winding of long positions that the markets really seem to have been looking at. And that's brought the prices on the weaker side.
Thanks a lot for that, Manisha. And that brings us to the fifth headline today. Moving on to Sun Pharma, it was down close to around 1% despite reporting a pretty much in-line set of numbers. Ekta is with us to run us through a quick analysis on that one. Ekta?
Thanks for that. Well, yes, Sun Pharma was largely an in-line set of numbers. So the revenue growth was a total of around 14-odd%. The street was anticipating around a 13% growth. EBITDA came in at around 3,000-odd crores, which was in line with estimates, which resulted in margins, which came in at around 26.7%, versus around 26.4% same time last year, and in line with estimates. Similarly, profit growth was around 5% in terms of a total growth on a year-on-year basis. Now, a couple of key points this quarter. The street was anticipating a good growth from the specialty business, which basically comprises of key drugs such as Illumia, which is a psoriasis drug, Sequoia, which is an eye drug, Winlevi, which is an acne drug, and that has delivered this quarter as well. So it came in at around $222 million if adjusted for the milestone payment, which was in line with expectations, and versus around $200 million in the previous quarter. So a growth on a Q-on-Q basis. Totally, the US business, inclusive of Taro, came in higher on a Q-on-Q basis, $422 million, which was up 6.3% year-on-year, and versus around $412 million the previous quarter. India fell short a little bit in terms of expectations. The growth was 7.1% year-on-year. Street was anticipating anywhere between 8 to 10% this time round. So overall, it was largely an in-line set of numbers. India fell short, but the specialty business continued to grow.
Thanks a lot for that, Ekta. Well, it was an equally positive quarter for Godrej Consumer as well, with a largely in-line set of numbers. Actually, the numbers are a little bit better. The FMCG major also reported double-digit growth momentum in the personal wash and hygiene segment. Mangalam joins us to run us through analysis on that set of numbers. Mangalam?
Well, Godrej Consumer, prima facie, these numbers are better than expected, and that's primarily because the expectations themselves were based by the company in their third quarter preview itself. But two things that really stand out from the numbers this time around. We start with the India volumes that have grown by 3%. The street was bracing itself for a number of just around 1 to 2% odd. And secondly, the EBITDA margins have remained stable year on year, and this despite a 70 basis points increase in ad spend. So that's telling you that, the company is sweating its operating performance well and using their gross margins as well, because gross margins year on year have seen a 50 basis points improvement, but quarter on quarter there's been a near 280 basis points improvement in their gross margin. So ad spends as a percentage of sales coming at 7.7% versus 6.9%. In the other geographies as well, the Indonesian business, while it has seen a decline of 3% in the revenues, it's actually a positive growth ex sanitizers, a positive growth of 2%, and that reeks of sequential improvement. There's been an 11th running quarter of double-digit growth in their Africa business, so that does well for them. And in India as well, growth has been led both by home care, which has grown by about 10%, and personal care, which has grown by 14%. Personal care business led by the hair colors business, and home care, of course, led by household insecticides and air fresheners. So all in all, good performance coming in, slightly better than expectations.
Well, Mangalam, we can't let you go at that. Westlife gained close to 6% on a solid showing in the past quarter. Tell us, Mangalam, more about that set of numbers.
Stellar performance coming in from Westlife Development this time around. Remember, this is the company that owns and operates the McDonald's franchise in south and west part of the country, and the company has reported an all-time high sales in terms of a quarterly performance, led by 20% same-store sales growth. They also saw a significant jump in dine-in guests. So just to apprise you of the numbers, 29% jump in their EBITDA, gross margins also up by almost 80 basis points, and 29% jump in their overall revenue, led by 20% jump in the same-store sales growth. So on a low base, the net profit actually surged by about 75%. They've opened 6 new restaurants in the quarter, on track to go on and do about 35 to 40 in this entire year, and close to around 580 to 630 by 2027. What led them in terms of growth this quarter? On-premise business, which is dine-in business, saw a 42% year-on-year growth on a feeble base. At the same time, it's higher by about 23% pre-COVID. And all this while delivery continues to do well for them. Off-premise business grew by about 12% year-on-year and 85% over pre-COVID levels. Shares up by almost 6% after a stellar run that the stock has already seen. So investors would perhaps, like in the McDonald's tagline, say, I'm loving it.
Absolutely, loving it indeed with those set of numbers. Westlife ending high with a gain of around 6%. But on that note, we'll wrap up on this edition of Markets Today. We'll leave you with visuals of the top team at North Block. The budget makers are ready. Tomorrow, the Finance Minister will present the budget, and CNBC-TV18 is your budget destination.